All right, welcome to OK Computer. I am Dan Nathan. I am joined by my old friend, podcasting friend too. You're one of the very first guests that we had on the Tape podcast. That would be Jeff Richards. He's the managing partner at Notable Capital. Jeff, how are you, man?
I'm great, man. Thanks for having me back. I got a little sunburn from spring break with the kids, but other than that, all good.
All right. Well, if that's the worst thing that happened on spring break is a little too much sun, you're doing okay. Now, I said Notable Capital. I think many of our listeners, many of our viewers know you from GGV Capital. There's a name change there. We're going to talk a little bit about what's gone on. A lot of really exciting stuff from what I can tell. You and I are going to talk a little bit about the thawing of the IPO market. A name in your portfolio is set to go public this week. Pretty exciting stuff there. I want to do generally just a vibe check on valuations in the private markets, and let's talk a little bit about what you're seeing in the public tech markets and really, what pulled forward maybe some of the excitement in and around generative AI, just not only in the chip space, but we're seeing it in servers, we're seeing it in memory, we're seeing it across a whole host of other things. We're not seeing it so much, I don't think, in a lot of these kind of application software names in the public market. So we'll kind of discuss that. I know that is a specialty, but really importantly, also, you and I had a great conversation with Garrett Lord. He is the founder and CEO of Handshake. And this is really interesting because this is a company to me that I didn't know anything about. But when I asked my 20-year-old college daughter about Handshake, she said everybody and anybody who is looking for a job in college is using Handshake. But I learned from Garrett also, it's not just about kids in college and the mission that they have. So that was a great conversation, part of our Funders and Founders series brought to you by RBC Capital. So stick around for that. All right, Jeff, I'm going to stop talking here. Let's talk about Notable. What has gone on here with Notable and some of the structure change that you guys have? Because again, it seems really interesting, especially in this time for the VC world. Again, you guys have not only been a Silicon Valley notable firm, but you've also invested all over the world. I think that has something to do with the change.
Yeah, and first of all, let me just thank Garrett for coming on with you and I. He's just a superstar dynamo founder. As you'll hear in the episode, started this company with a huge mission to change the way that kids in college and even post-college interact with employers, and he's done that. It's a pretty amazing story over the last decade. He's got over 15 million kids on the platform today, and as you mentioned, every kid basically starting at any major college or university in the United States sets up a Handshake profile, which is just incredible to watch. And they're just laying the groundwork for an amazing future. And then on the Notable front, we're really excited about it. We just announced it. It's a rebrand for the U.S. team. We've got 4 investing partners in the U.S., 7 total, been working together for an average of 13 years. So it's kind of exciting to be able to launch a new brand in an exciting market like venture capital, but also have the longevity that we have, a 24-year history. Obviously been able to invest in a lot of great companies like Airbnb and Square and HashiCorp and Affirm and StockX and, many Handshake, many others that are private and up and coming. But to build on that with a new firm and obviously the trust and track record that we have with our LPs is pretty awesome. And we're pretty excited about the road forward. And, we will be focused predominantly on the US, some exposure to Latin America, Europe, South America, but just focused on the US. And it was, when the firm was started 24 years ago, global investing was a big theme. And obviously in the last 5 to 10 years, that's shifted a little bit as different countries have had different agendas and strategies. But we're pretty excited. I mean, to be able to invest in the US market, which is the biggest technology market in the world, not getting any smaller, is a pretty awesome opportunity. And we're just grateful for the LPs that we've got who are backing us in that endeavor. And obviously a huge portfolio of companies that we're going to be working with for, 10 plus years to come. So as you mentioned, you call me your old friend. I hope I'm still young, longevity in the relationship, but we're very committed to a long-term path here as Notable Capital. It's gonna be a lot of fun. And we named the firm, I think most importantly is we named the firm after the founders that we back, the ideas that they pursue, and then also the causes that we work for, which are the LPs, the retirement funds, the endowments, who we work for. That's who we generate returns for. And so the idea is those folks are notable. It's not about us, it's about them, the founders, the ideas, and the causes.
Well, it's interesting, and when I say old, you are a young man. I'm a bit older than you here, but I think I met you in 2017. It was an event I think that you guys were hosting in San Francisco. It was, the VC community. It was some founders, and again, one of the things I've always found really interesting about you and friends like Rick Heisman and Katie Stanton, at Moxie. I mean, like you guys really do put your founders first, and I think that's one of the things. I was looking at the new Notable website, and there was a quote there, or a stat: 70% of the investments that you guys have made have come from referrals from existing founders in your portfolio. That is astounding to me, and it does speak volumes about kind of the business that you guys have built and the partnership in general. So very cool stuff. We're looking forward to kind of following this new name, this rebrand. That's really exciting. Let's talk about the environment. And again, going back to the period when I think I met you, it was really like the go-go times. This is back in 2017. The focus was just on a lot of consumer-facing, internet-based apps and the like. And it seems like we couldn't be further from that right now, if you think about it. And I know, Jeff, you were, a former founder in the tech space, and you've operated in different cycles. You've invested through some very different cycles. Give us a sense of like kind of where you think we are right now as you think about, just the valuations in the private markets, some of the IPOs that we've seen come to market over the last few months or so. There's been some hits, there's been some misses, but in general, there haven't been a whole heck of a lot, especially in a dollar volume, that sort of thing. I think the numbers year over year are probably up just a little bit. But man, with the NASDAQ at all-time highs and the S&P at all-time highs, you'd think that this would be a pretty good environment to bring some deals to the public markets. Just give me a sense of like kind of what the vibe is out there, at least right now.
Yeah, I think, look, we've had almost a 2-year, basically an IPO drought, where there have been very few new offerings of new software, consumer, fintech, any type of company, really. And I would say it's attributable to a couple things. One, obviously, when the market dropped for tech in 2022, you typically see a lag into the private market. So the public market went down in kind of Q4 21, Q1 22. You then see this, fall over into the private markets. And one of the challenges that we had in the private markets was we had a record amount of venture capital flow into companies. When I got into venture capital in 2008, I think the US market was around $30 billion a year for venture capital in total. And we got to a point in 21 and 22 where it was, 100, 200 billion. And just a lot of capital all over the world, frankly, not just venture capital firms, but strategics, family offices, hedge funds, pension funds and endowments making direct investments. So people really got enamored with the idea that they wanted to be investing in these companies that were private. And I think there were a couple things driving that. One, the growth of those companies was extraordinary. So everybody was riding the mobile wave, riding the cloud wave. You just saw phenomenal growth in these companies that were growing at 100+% per year. The second thing was, as 15 plus years ago, we had Sarbanes-Oxley, which sort of changed the dynamic for companies going public. And Facebook famously waited quite a long time to go public. And so a lot of the value has been perceived to be created in these companies while they're private. In the old days, Amazon went public in 1995 at 500, I think it was a $500 million market cap. Today, that's at least in 21, 22, that was a Series B or Series C round. And so a lot of the value in these companies was accruing to the private market investors, and then they were going public at 10, 20, 30 billion. So folks were looking to get into those companies earlier. They poured a lot of capital in the market. Of course, what does it do? It drives up prices. It drives up valuations. Those valuations turned out to not be sustainable when the public market corrected. And so one example of a category that I invest heavily in was vertical software. When we were investing in vertical software in the first half of 21, the average public vertical software company was trading at roughly 25 times forward revenue. Today, it's at 6. And so you've seen this roughly 80% compression in the public valuations. That takes time to work itself into the private market. But if you were a private company that was valued at a premium to that, so you might have been valued at 50 times forward revenue, you've got a long way to grow into that valuation and sort of earn what would then be your public comp if you were to try and go public as a company. And so I think what you saw in 22 and 23 was a couple of things. One was a headwinds in certain categories. So we saw headwinds in consumer, headwinds in software spending, and certainly headwinds in fintech. And so the growth rate of those companies got adjusted downward. pretty dramatically. I was with one of the top bankers who does a lot of IPOs last summer, and he said, look, we've got two problems. One, we don't have any lack of demand. There's a ton of demand from the public side to be investing in new names. The problem we've got is, one, the companies are overvalued. So the valuations that were set in 2021, 22 are too high relative to the multiples that their public comps are trading at. And two, their growth rates slowed down. So anybody that thought they were going public in 23 gave this banker a forecast for 23, 24, 25, and then had to revise those downward because the market wasn't growing as fast as they thought it might be. And we particularly saw that in the software and enterprise spending category, where CFOs and CEOs really ratcheted back spending. In some cases, headcount. A lot of headcount drives software spending. You asked about what's happening in the software landscape. That's a big change, right? When tech and banks and other industries like that cut back on headcount, they spend less money on software.
Yeah. So Jeff, let's go back to the valuations that were, kind of set in stone in late 2021, which was really hard to kind of grow into and hard to bring to the public markets, especially a public market that was a bit dicier. There was an article in the Information last week, AI valuations may be coming down to earth. And I thought it was interesting. They have a table here. So the average public SaaS companies are trading at about 7 times revenue. Okay. But it's listing all these names, and you know what they are. Cohere at the top, 227 times, Hugging Face, 142 times, Vast Data 90 times, Anthropic 75 times, Perplexity 67. So here's my question to you. You can kind of look back at that like last class of vertical software companies in the private markets and say, we've had 2 years of really difficult times and inability for them to grow into, some sort of valuation that makes it palatable for public market investors. Now we've just minted a brand new class of companies in the generative AI space that, again, these valuations are pulling forward a lot of growth, and you better have a full-on public market, bubble to bring these things, to market. You'd say right now with the S&P at about 21 times, and that's earnings, okay, and very top heavy, right, to the largest names, and it's the Microsoft trading at 35 times, and Amazon and Meta, and which is probably pretty reasonable for all intents and purposes. But my question is, like, we just did this again now 2.5 years later or so, you know what I mean? So might we have an extended period of just difficulty bringing new issues to market? Because you just gave the example of 25 years ago when all of those internet companies that went public, and most of them were not profitable, but they had really good earnings growth, or they had really good sales growth, obviously, right? They were coming at like sub-billion-dollar valuations.
Yeah, a couple thoughts I'd share with you. So I don't think the companies that will go public in 24, 25, 26 are going to be the AI companies you reference. Most of those are still very early in their growth cycle. Some of them are even pre-revenue. The companies that are going to go public, we had this sort of quote unquote 1,400 unicorns that were minted in 21 and 22. If you assume that maybe 10% of those are going to be really great companies, that's 140 companies. Maybe you take half of them and they're actually ready to grow into the valuations that they had set way back when, 2 years ago, 3 years ago. You're going to see some of those companies come out in 24, 25, 26. They're going to be multi-hundred million revenue, maybe even over $1 billion companies. Those are good companies. They're not the super sexy, pure LLM, AI, chat GPT type ecosystem plays. Most of them will have some interface with AI because AI is going to be so prevalent in the tech stack for any, both consumer and enterprise. But I think what you're going to see is the companies that'll come out this year and next year, there'll probably be, 10 to 20 IPOs in the back half of this year, tech IPOs, maybe more. And then you'll see a handful that'll come out next year, but they're going to be companies with 2, 3, 4, 500 million of revenue, good solid growth. In some cases, they're going to be profitable. I mean, one of the positive effects of the changes that we had in 22 and 23, and folks like Mark Zuckerberg cutting 25,000 employees, Salesforce cutting employees, Google cutting employees, that emboldened the private companies to do the same thing, to get leaner, to get more efficient. And so you'd be amazed. We're seeing a very high percentage of the companies. I'm on the board of several companies that are profitable. I've got quite a few that are burning what in our world, what we refer to as a burn ratio. So are you burning less capital than the net new ARR you're generating throughout the year or booking throughout the year? So I think you're going to see a healthier crop of companies come out in 24 and 25 than you would have otherwise. There will still be some companies that maybe are not quite as healthy, but there's a lot of great companies that are going to be coming out. And then, of course, you have this next class of companies, the ones you're referring to, that are more this bet on the next generation of AI. And I think what you're seeing there is the market is one, there's a lot of strategic money in those funding rounds. So you've got folks like Google, Microsoft, Nvidia, Facebook, Amazon, et cetera. They're putting a lot of capital and so-called credits into those companies because to build out the infrastructure for AI is actually quite expensive. So a lot of that capital that's going into those companies is actually going to purchase underlying infrastructure from folks like AWS and Google and Microsoft. So it's in their best interest, and NVIDIA, most of that money flows back to NVIDIA. So it's in their best interest to make sure that that ecosystem is well fed. So I think a little bit of what you're seeing around the froth in AI, some of it is very real. Obviously, the excitement that people have for the future and how important this technology and this concept is going to be for our economy and the tech ecosystem broadly, I think is well deserved. But a lot of the funding that you've seen in the last 12 months has been, Morgan Stanley put out a report that estimated that 90% of that funding was coming from strategics. So if that's the case, the market really isn't as frothy from financial investors as maybe we might think otherwise.
Yeah, but it's interesting. So Rick Heitzman and I had this conversation, I think a week or two ago, but that capital that's coming from strategics, because it's flowing back to them in many different ways, is less price sensitive. And I guess that's the point. So when you look at the funding rounds and the size of them and the valuations, you say to yourself, okay, I can see why these strategics are doing what they're doing, but at the end of the day, it might be really hard to see these things have public up rounds at any point, in 2025 or 2026, if they ever get there. I want to hit you on something here, because this is not something I think in your career as an investor or as an operator, you weren't contending with rapidly rising interest rates. If you think about this environment and really that has a really big input to valuations here, right? And you heard Jamie Dimon earlier in the week in his he wrote this kind of annual letter, this opus, talking about the potential for maybe 8% interest rates. We have a Fed funds rate at 5.5%. Coming into this year, the expectation was that we were going to have 6 rate cuts this year. The S&P, the NASDAQ just took off on that, right? Well, here we are. We're much higher in the public markets, and the expectation for rate cuts has come down dramatically. And then you have somebody like Jamie Dimon, the most important banker on the face of the earth, saying that you better brace yourself for much higher interest rates. How does that factor into, let's just say, what you're thinking about valuations, what you're thinking about new investments in general? Because again, it seems like at least in the public markets, they haven't batted an eye on higher for longer, but it seems like at some point that's going to kind of weigh on at least investor sentiment at some point, because we haven't even had the recession that 2022 in the public markets was pricing in.
Yeah, I think one, there are very few people in our industry who think about how the economy or the market may behave in the next 2 to 3 years, just because when we invest in a company, typical duration is 7 to 10 years or more. So I don't know where interest rates in the economy are going to be in the decade. I'm betting on founders. I'm betting on big ideas. I'm betting on, revenue growth in categories we may not even thought about yet. When Amazon went public, it was predominantly selling books. Today, its most valuable asset is AWS, which wasn't created till 11 years later. So much of what we do is bet on founders and the ideas and the innovation and hope that it plays out over a long period of time. I think, though, where it does play a role in our universe is when you have high interest rates, it gives people other places to park their capital and earn yield. And so from an LP, family office, endowment, et cetera, perspective, obviously, one of the reasons so much capital was flowing into risk assets like venture capital 2 or 3 years ago was when interest rates were at zero, you weren't getting yield anywhere else. So that's probably the biggest thing that I think of when I hear Jamie talk about higher for longer, is just, what does that do for people's appetite to put risk capital to work? I think balancing that is the fact that our LPs, at least the ones that I speak with, are thinking the same way we are, which is they don't know where rates are going to be in 7 to 10 years. We don't want to miss the next Facebook or the next Google or the next NVIDIA because we thought the next 12 months could be challenging for the economy or for interest rates. So it's a very different game, I think, than folks that are trading day to day in the public markets. The only other thing I would say is, there's a lot wrapped up in those thoughts around government spending and inflation, and all of those things do have an impact on the way that the end customers spend for our companies, i.e. how do consumers spend for the fintech and consumer companies, how do enterprises spend in the enterprise software world. We definitely saw headwinds in enterprise software last year. Why? Because CEOs were cautious, CFOs were cautious. Coming into 23, as they heard talk of recession, they didn't want to take up their IT spending budgets when they thought that there might be a recession coming. So I think as long as you have uncertainty, it causes people to be less aggressive in their spending. And uncertainty in our world is not a great thing. We'd like more certainty, but I don't know about you. I don't see more certainty coming in my universe just from geopolitics and the economy and rates and inflation. We got an election coming up in November. So I think what you're seeing now is large enterprises, Fortune 500 in particular, they are investing heavily in AI and some of these newer technologies because they know if they don't, they're going to get left behind. Learn the lesson from the internet, learn the lesson from cloud, learn the lesson from mobile. If you don't invest ahead of the curve, you will get left behind.
Yeah, no doubt. And just kind of, I think that's a great distinction about how you're investing and the time horizon, but it changes very quickly. So like, for instance, and it might have gone public by the time you're listening to this, but Ibotta, this is a company in your portfolio. It's a profitable company. It's a digital marketing software firm. It's going to be what, a $2.5, maybe $3 billion market cap or so. But these are the things that quickly, all of those sorts of macro stuff, because digital marketing, it's a very cyclical sort of business, that sort of thing. If there's not a generative AI story attached to it. Again, I don't know this company. Obviously, you know it really well, but these are the things that public market investors are going to start focusing on from the moment that bell rings, right? When the company goes public, either on the NASDAQ or the NYSE.
And I think what you're going to see for the companies that come out in 24 and 25 is investors, public market investors are going to be very focused on how durable is the growth and the story for this company. They learned the lesson in 21 and 22 when you had, the WeWorks and other companies like that went public that didn't have a long duration story and strategy. You had the whole SPAC phenomenon, which is a whole nother conversation. But, when you have the time, and the same thing is happening in our universe today, where in 21 or 22, I might have only had a couple of weeks to evaluate a private company and decide whether we want to invest. One of the nice things about the market today is we can actually take the time, build relationships with founders, understand their business, really understand the durability of their market. I think you're going to see that in the public market as well, as the Fidelities and T. Rowe's and the hedge funds look at these new companies coming out. They're going to say, how much of this is a near-term story and how much of this is a durable, 5, 10, 15-year grower / compounder. There are going to be a few that are coming out that I'm bullish on, that I'd love to own at the right price and, capture the next sales. People forget Salesforce was a $2 billion market cap company in 2008. 8 years after it went public. Today, it's over 200 billion. So there are going to be some 10, 20, 30, 40, 50 baggers that come out of this IPO class. The trick is figuring out which ones have a durable, resilient business model, high margins. But one of the questions, if you're coming out as a profitable company, you check a box that not many companies were checking in 21 and 22 when they were going public.
Yeah, no doubt. Let's focus a little bit on some of those sort of 200 billion plus publicly traded software companies. One of them that's really caught my eye of late, and again, let's just kind of set the stage here. The S&P is within 1% of the all-time high that's just made. So is the NASDAQ here. Look at a name like Adobe. Last summer, this is one that, again, a lot of investors were very confident about a generative AI strategy across their suites of products and the like here. And it's interesting, as the NASDAQ was seemingly making new highs, every day for the last couple months or so, Adobe never made a new high. It was 10% off of its all-time high made in 2021, and now it's down some 23% or so, Jeff, just in the last couple months after a disappointing quarter and guide. And I don't want to focus too much on Adobe, but what's interesting to me is that the generative AI trade appears to be getting more and more concentrated, like in the public markets, right? So Microsoft right now, is trading within 1 or 2% of its all-time highs, and it's been basing, people seem very confident in what they're going to do, how they're going to execute, how they are going to monetize that open AI investment and the technology across, like no shortage of different verticals that they have. The same obviously goes for NVIDIA, despite the fact it's more than, let's say, 10, 13% or so off of its recent all-time highs. Google just made a new all-time high despite having very low expectations and very poor sentiment in and around what they are doing in generative AI. But the market, or investors in particular, are becoming a bit more choosy in the public markets, in my opinion, and therefore the trade is becoming that much more concentrated. Talk to me. I'm just curious. I know that you don't stare at FactSet screens all day long like I do, and the like. I'm just curious though, because are these things that are kind of getting your radar or your antennas up a little bit?
Well, the main thing I would say here, and I'm, can't speak too much specifically to Adobe. I mean, it's been obviously an amazing company under Shantanu. I mean, if you just look at revenue for Adobe, I'm looking at it right now, it's tripled in the last 4 or 5 years. So it's not like they're not doing well as a company, but the stock obviously has had a good run as well. The one thing I would say is, if you look at the time that it takes to build out infrastructure like AI, and we saw this with the internet, right? You had an enormous amount of CapEx spending on telecom infrastructure and internet infrastructure in the late 90s. You had a crash. And then literally a decade later was where most of the value got created with Facebook and companies like Uber and Airbnb, and kicked off the whole mobile wave with the iPhone and the App Store. I think this is going to take time. And so what you're seeing, to your point, the bifurcation is, who benefits in the near term? Well, obviously NVIDIA benefits in the near term. Why? Everybody has to buy their hardware. Who else benefits? Amazon benefits, Microsoft benefits, Google benefits, because all that spending that goes in infrastructure and laying the groundwork for the innovation and applications that are going to happen on top of it. The question is, how long does it take for the revenue to flow to those layers above the infrastructure layers? And I don't think we know the answer to that yet. I can tell you that, in our portfolio, are we seeing excitement and interest and new bookings? I have one company where 25% of our bookings in the second half of last year were for our AI-related products. But you're talking about single-digit millions of bookings. You're not talking about hundreds of billions in bookings. And so I just think everybody got very excited about the impact of generative AI. It is going to have a major impact. Is it going to happen tomorrow? Probably not. There were a lot of stories about Hollywood. Gosh, Hollywood's going to be completely reset because of Midjourney and Sora and all these other amazing technologies. And it probably will over the next 5 to 10 years. But are the blockbusters of summer 2024 going to be driven by AI? Probably not. So it's just going to take time. And Adobe's a great example. Any company in the software category, frankly, you have to ask yourself, how quickly is this going to provide a tailwind to that company, and how much of that could be counteracted? For example, one of the popular trades among hedge funds last year was to not be long or to even be short seat-based software. Why? Because as the Salesforces and Googles and even folks like Goldman Sachs, as they reduce headcount, they spend less money on software. If your pricing is based on per seat, you just aren't going to charge the customer as much when you go to renew. And we saw that in net dollar retention numbers for public companies. So I think you have to ask yourself in 25 and 26, where are the tailwinds for AI? There are obvious categories like customer service, where it's going to probably have an immediate near-term impact, financials. But on the creative side with Adobe, obviously they tried to buy Figma. That deal didn't go through. You've got Figma and Canva that are also eating part of the market that Adobe is going after. So it's just a really interesting dynamic. And by the way, Figma and Canva could be companies that go public in 25. And so do you want to own Adobe, or do you want to wait and buy those names when they come out and they're growing obviously at a much faster clip and are more of a pure play bet on AI than maybe Adobe is? So it's a really interesting time. I mean, for me, these waves happen every 10 years. Had .com bubble, then we had the cloud mobile wave in 08, 09, 010. I don't know how it's going to play out. All I know is you made a lot of money if you made bets and if you made the right bets in those cycles. And so my big lesson learned from 08, 09, 010 was, when you see a tectonic shift like that, you want to be betting on it. And I think you're seeing that with LPs. You're seeing it with all the folks that are pouring capital into this shift. They don't know how long it's going to take to play out, but they know it's going to be big.
Yeah. Yeah. With all that said, and before we get to the conversation with Garrett, I'm just curious, like, again, a lot of our listeners, we know that your firm, you are not mark to market. So you don't have to worry about the palpitations in the public market, or whether Fed funds is going to be, down at 5% or up at 6% in a year or so. But when you think about just, the kind of sentiment towards this, let's call it a tectonic shift in computing, right? And much like those two different periods that you just mentioned, 2010, and let's call it the turn of the century, right? So here we are, we have another one here. Would you like to see some sort of fear put back in the public markets though? Like, because we have not had, you ready for this? We have not had a down 2% day in the S&P 500 in over a year. Just think about that, Jeff. Like, so the level of complacency in a in a rapidly rising interest rate environment, let's call it over the last 2 years, all that volatility was kind of front end loaded before we got the bulk of the rate hikes. And so I'm just curious for you, does that even matter? Like the level of complacency that exists in the public markets, might it help just the ecosystem in general to have a little fear put back into it? Because I'm sure you found some really good opportunities in 2022 coming into 2023, right? With depressed valuations and sentiment a little bit poor, because right now things feel a little bit euphoric despite some of the bifurcation we're talking about in the public markets.
Yeah, they haven't been as euphoric on the private side. I mean, I would bet you that outside of the AI funding, the venture market's probably down 80% from the highs of 21 and 22. That's a big number. For those of us who watch it daily and subscribe to newsletters that feature financing and things like that, you just don't see a lot of the top names that you used to see literally every day and every week investing in companies. And there's a whole kind of asset class, which was sort of growth stage private, call it between 500 million and 5 billion, where you had a lot of hedge funds and crossover funds that were putting a tremendous amount of capital to work, and names like SoftBank. Those folks a lot of them are out of the market. They're not putting any money to work in privates right now. So I can tell you, for folks in our world, it doesn't feel euphoric outside of the AI financings. And if you talk to founders, for the most part, unless they've started their company in the last 12 to 18 months, it doesn't feel euphoric at all. It feels really challenging. It's very hard to raise capital. And you've got a lot of companies that are going out to raise, and they're going to be lucky to raise it at the same price as they raised 2 or 3 years ago. And many of them are going to be doing down rounds. So it doesn't feel euphoric in the private markets. I hope, I think for all of us, we hope that there's strong receptivity to the companies that go public in the second half of this year and into next year. I hope we do a good job of pushing out some of the best companies, those that have good growth rate, durable long-term strategy, good margins. I don't want to see another resurgence of the SPAC phenomenon. I think that was bad for everybody. A lot of not so great tech companies that couldn't have gone public, frankly, that got pushed onto, unwitting Robinhood investors. I just think that was a bad dynamic all around. So I think we're in a better place. I think we're in a healthier place, again, outside of the euphoria around AI. And I think, back to your point, even on the S&P 500, how much of that growth and rise has just purely been in sort of the top 10 names or the top 5 names now versus, the rest of the S&P 500. One of my favorite personal trades has been the financial folks, the private asset managers, the Blue Owls, TPGs, Blackstones, KKRs. Those names are up 60 to 100% in the last 12 to 18 months. It's not that easy to explain why, other than I think people have realized that when markets are challenging, they are the folks that go out and buy things on the cheap. If rates go down, it'll be better for their business. And then I just think there's a long-term stream of capital that's going to keep coming into the private markets. But, you tell me, why are those names up 70 to 100% in the last 12 to 18 months? But outside of that, how much valuation accretion has gone to the other 495 companies? I don't think it's been that aggressive, has it?
No, and on a valuation basis, it has not been. It's something, again, but I guess the biggest concern, Jeff, is like, so if the valuation's being pulled up by those top, 5 to 10 names, the earnings growth is also hinges on those top 5 to 10 names. So if you were to have an economic slowdown that maybe is brought on by the long and variable lags, right, of tighter monetary policy, right, like at some point, a lot of these companies, are not going to be able to push through, price increases, you know what I mean, as you've had input costs go up, and then, you have this higher for longer rate environment. And, sooner or later, you're going to have an economic slowdown, and it's going to start to be felt probably first by the names that have been masked, you know what I mean, by the larger names, right? You're going to see it in industrials. You're going to see it in some consumer facing. You're going to see it in retail and the like. So to me, again, a lot of it hinges on those 5 to 10 names, and you better hope that you don't have a pullback pullback in enterprise spending, because when that happens, it's lights out, right? And so when I think about some of those names that you just mentioned, the Blackstones and the KKRs and the like, they've filled a void. Think about what we just anniversaried, right, with the crisis that we had in regional banks. And for many, if you look at the KRE, which is the index that tracks the regional banking index, it's down on the year. It's well below its 52-week highs, while we've had, the XLF, which is, marked by, JP Morgan and some of the largest money center banks. The regional banks have not really recovered a whole heck of a lot. So to me, a lot of those, the private equity or private credit now, I mean, they've filled a big void, but they could be a disaster waiting to happen if Jamie Dimon's right about 8% interest rates. You know what I mean? Like at some point, the chickens have to come home to roost. When you think about 2020, we had this black swan event, right? We talk about those things in our markets all the time, but they don't really happen too frequently. Well, the S&P didn't even go down. It was the quickest 35% plunge in the beginning of the year. It was up on the year, right? So I just feel like we've just kind of, kicked the can down the road a little bit. And 2022 in the markets felt very orderly to me as far as a correction that we had. So that's just my 2 cents. That's my little fast money hat.
I mean, the hidden part of Jamie Dimon's comments was government spending. I mean, we continue to spend beyond our revenue. We continue to be a counterforce to trying to drive down inflation. And so, we continue to put out stimulus, right? When you forgive, quote unquote, student debt, it's stimulus to the economy. And so to me, that's probably my biggest concern. I mean, you've got the average family going out and trying to have dinner with their kids, and it's costing 35, 40% more than it did 2 or 3 years ago. I just don't think that's sustainable. So that, to me, the biggest risk to the quote unquote economy is that at some point we break the consumer, we break their ability to keep living and going out and spending on, as I spend a lot of time in SMB tech. SMBs are 42% of US GDP. 55% of the American workforce is tied into small businesses. If we see a slowdown, and most of those, by the way, are restaurants, boutiques, hair salons, et cetera. If the consumer cuts back on spending because things have just gotten too expensive, or their incomes start to go down, or unemployment goes up, then you're going to have some real challenges. The only thing that I think is so interesting is we're talking about a market that's been on a tear for the last 12 to 18 months while rates were going up. So now at least we have some flexibility to lower rates if things get worse. We didn't have that flexibility 18 months ago. I guess that's the Fed put, is the idea that we can do something if things go awry. But to me, inflation is just, and that was what I took away from Jamie Dimon's comments, was we have not gotten inflation under control, and we may have to push rates higher until we do. But so much of that is being driven by continued government spending. I just don't know how I don't know how that changes. It seems like both parties have gotten addicted to spending beyond our means. This isn't a Democrat or a Republican thing. It's happened under the last 2 presidents.
Yeah, no doubt about it. Well, again, I think that a lot of folks are kind of echoing that same sort of warning, and the tools that they used to have, you know what I mean? Like the idea that, okay, we're at Fed funds at 5.5%. Well, if there's some sort of calamity that comes along, we can lower them. But if we lower interest rates, it may actually do the exact opposite of what we need to have happen with inflation. And, a lot of folks are talking about, well, what the Fed is going to do. We're in this election year. Lowering interest rates right now would not have the sort of effect that many folks think it might for the economy or for the consumer in general. It might do the exact opposite. So the idea that the Fed doesn't do a single thing, I don't think it's political by any means. I think they're very focused on really doing their best to make sure that inflation does not become embedded in the economy the way that it did in the 70s, you know what I mean, if you will. So a lot of the normal plays out of the playbook, I don't think really kind of, are going to be too effective in this sort of environment. And to your point, the only way to do is to better balance our books, right? But both parties don't seem to be committed to doing that one way or another.
You need to run for office. We need somebody to do that. Somebody needs to go pull a Bill Clinton and say, we got to live within our means. I mean, he did it. It's doable.
Yeah.
I don't know if you saw, they just came out, the CBO just revised the budget numbers for the year, and we're off by 47%. We've already spent 47% more money than we thought we were going to. To me, that's the biggest risk to the whole story right now, is we've got to figure out a way to live within our means. I mean, the rest of the world is supporting our growth and our economy. And at some point they're going to sort of say, hey, we're not down with that anymore. But I don't know, again, beyond my sort of pay grade, but the trickle down for folks in our world would be, if that has an impact on enterprise spending, if that has an impact on consumer spending. We have not seen any slowdown in consumer spending in SMB for the last 2-3 years. Since COVID, when many of those small businesses were essentially taken offline, their businesses have been doing very well. Obviously had supply chain issues and challenges finding workers. But the data that I have, as you know, I'm on the board of a company called Homebase. We have very accurate data on 200,000 merchants and over 2 million employees. We've not seen any real slowdown in growth for those SMB merchants. But if we do, it would have a massive impact on the overall economy because, again, 55% of Americans work for these businesses.
Yeah, but Jeff, I mean, think about it. Like the companies that everyone out there are investing in right now. I mean, when you think about what they're going to do, they're going to displace workers, right? Like that's the whole idea. And where are they first going to come? They're first going to come in large businesses that are already been cutting costs because they overhired, during the pandemic. But then ultimately, it's going to trickle down to small and medium sort of businesses. So to me, prior to the pandemic, you remember we were worried about automation and the robots taking all the jobs, and we're talking about things like universal basic income or whatever. Well, you better dust off those sorts of conversations, if you will, because I don't really know how this fixes itself. And then this whole idea, while you talk about all of the government spending, and the CHIPS Act is doling out $20 billion to Intel. Just yesterday, the announcement of $11 billion to Taiwan Semi, Global Foundries. Well, what are they trying to do? They're trying to reshore some of these jobs here. Well, that's really inflationary too. So it seems like every sort of idea that we come up with, you know what I mean, to kind of combat, the kind of issues that we had that caused the inflation, which would be disruption to supply chains because of a pandemic, or whether it be a war in Europe, or whether it be threats to Taiwan semiconductors manufacturing in Taiwan. It's inflationary. Then you do fiscal stimulus, right, to incentivize companies.
You're gonna put me in a bunker, and I'm just gonna have to sit there and own T-bills, Dan. You're scaring me.
Hey, well, why not? You know what I mean?
I do have a counter to your AI narrative on small business, which I actually think it's going to be a tailwind for small business. It's going to be a headwind for hiring in big tech. I've tweeted that out. I think in small business, if you look at the average small business today, let's say you've got 10 people working in a shop. The owner does the accounting, the owner does the sales, the owner does the marketing, the owner does payroll, the owner does HR. They don't have people doing those functions. So when you throw AI into the mix, and you're already seeing this today, Intuit, huge adoption for their AI module. Companies like Shopify, Square, Toast, Procore, I mentioned Homebase, Brightwheel, Slice, all these companies that have an AI component that's going to start to weave into their technology stack and will just become part of the way small businesses run their business. It's not going to displace anybody because AI is not going to stock the shelf. A robot could stock the shelf, but the folks that are stocking the shelf and helping the consumer who comes in for a cup of coffee, I don't think it's going to replace those folks immediately. I think it's going to be a turbocharger for small business. And if we see call it a 2 to 10% lift for small business in America, again, 42% of US GDP, that would be huge, right? If you can go tell a million shop workers, hey, I can automate payroll, I can automate accounting, I can automate sales and marketing, I can automate, timesheets and time clock management, all these really important functions that they spend their time from 9 o'clock at night till midnight. That's what they do. You're going to displace that. You're going to make them more productive as a shop. I don't think it will have as big an impact on headcount in the near term. I do think it's going to have an impact on headcount in large tech, banking, telecom, big industries where you're going to be able to automate a lot of the think about bill payment, customer service, a lot of these functions that have, armies of people doing them. Those are going to be automated by AI.
Yeah, no doubt. And I guess the best example, to use for, that shop owner that basically, gets a lot of his time back is like, people were calling for the death of, local banking, right? When the ATM came around, and what it do, it kind of freed up a lot of the workers to do, just higher, more productive tasks, you know what I mean?
They're doing wealth management. They're doing,
exactly.
Yeah. So I think it's going to be a turbocharger for small business for the next 5 to 10 years. And the other thing that's going to be amazing, when the cloud and mobile rolled out, SMBs in America were not ready. They had never used any technology in their shop. It wasn't until you put an iPhone in that merchant's hands, they said, oh man, maybe I should be using software to run my business. You've now seen 15 years of technology adoption among those merchants, right? They all use, again, I mentioned Shopify, Intuit, Square, Toast, Procore. They are ready for this next module of AI, and it's going to slide in effortlessly and become something that they adopt and just start to add into the stack, I think it's going to be awesome, right? How many SMBs are good at sales and marketing? Very few. With AI, you can become very good at it overnight. So it's going to be exciting.
Yep, no doubt about it. All right, listen, you and I covered a lot of ground. We could have gone all afternoon if we wanted to, but let's do it again soon, Jeff. It was
right.
it's been too long, but listen, everyone, stick around for this conversation. Jeff gave you a little preview of Garrett Lord. You're going to get a great understanding of his background. It's a really interesting one in the company that he has built with his team over there at Handshake. So great conversation. Stick around for that, Jeff. Thanks so much for being here.
Thanks, Dan.